Good morning, everyone. My name is Leandros Kalisperas, and I am the Chief Investment Officer of the British Business Bank. By way of a quick introduction to me, I joined the bank on the 20th of January 2025, a date I can never forget since it coincided with the President of the United States taking office and therefore relegating my first day to an afterthought even within my own household. I joined the bank from the world of pensions and spent the previous 15 years stewarding capital across public and private markets for large long-term asset owners, including the largest pension plan in the UK, the University Superannuation Scheme, and most recently in Bradford as CIO of West Yorkshire's pension fund. Having now sat on both sides of the fence, first as a long-term institutional allocator of private capital, and now inside the venture ecosystem, one conclusion has become crystal clear to me. This country does not have an innovation problem. It does, however, have a capital formation problem. We create exceptional companies. The challenge is helping more of them scale here, remain here, and generate long-term economic value here. That is increasingly the mission of the British Business Bank. Many of you will have noticed, and any of you on LinkedIn and follow the British Bank's activity must have noticed, the huge increase in the scale of activity over the last year, over the last few months, over the last few days. We have been given a clear and expanded mandate by government, and in return we need to evolve the scale, speed, and style of our own investment activity. We hope those changes will be felt by many people in this room, whether you are a founder, a GP, or an institutional investor. This is an exceptionally exciting moment for the bank, but more importantly for the UK venture capital market itself. So this morning I just want to talk about three things: why the UK already has the foundations for a world-class innovation economy, where the structural gaps still exist, and how the British Business Bank intends to help close them. First, just given the changes that have recently been made at the bank, I wanted to shed a quick light on what we do. We were established in 2014 during the coalition government, 12 years ago. We are a public financial institution implementing on the country's innovation and development agenda for small businesses. The bank has two core competencies: banking and investments. Through our banking business, we support increased lending to smaller businesses, both directly through our startup loans for new entrepreneurs and indirectly through finance providers, using government-backed guarantees and other financial instruments to reduce risk and expand the availability of finance to a much broader range of businesses. Through our investment business, which I run and look after, we invest primarily in private sector VC funds, as well as directly in companies, across early to late stage financing needs, across a variety of sectors, and across the UK. Essentially, it is our, and more specifically my, responsibility to catalyse the development of the UK's venture capital market. I do not want to repeat too much of what will come shortly from the UK private capital session, but it is important to reinforce the scale of the opportunity in front of us. The reality is that the UK is already exceptionally strong at venture, and we have many of the core ingredients required for a thriving startup and scale economy. First, the UK is home to the third largest VC market in the world, behind only the US and China, and continues to take more venture investment than any other country in Europe. Second, we have a world-class research and innovation base. The UK is home to 4 of the world's top 10 universities, equal to the United States, and 16 of the top 100. Critically, we are also becoming increasingly better at commercializing the research coming out of those universities, given the improved infrastructure around spin-outs. And in 2024 alone, spin-outs accounted for 17% of the total UK venture capital that was raised. Third, we have a deep and increasingly dynamic startup culture. The UK's pipeline of innovative early-stage companies is the third largest globally and growing faster than the global average, with around 4,000 first-time VC deals between 2021 and 2023 alone. And as of January of this year, the UK had also produced 200 unicorns, again placing us third globally behind only the US and China. Importantly, we are actually now beginning to see the emergence of a genuine flywheel effect, a growing base of repeat founders, experienced operators, and recycled capital helping to strengthen the ecosystem over time. So there is a huge amount to be optimistic about. The question now is how we capture more of the long-term value created by this innovation economy here in the UK. And that brings me to the fourth point on the slide. While the UK has deep pools of domestic capital, our institutional investors still allocate significantly less to UK venture capital than many of our international peers. Which brings us to the scale-up gap. Many of you will already be familiar with the scale-up challenge as it is part of the national economic conversation, but I wanted to visualize it clearly. The core issue is that too many UK companies struggle to access sufficient domestic capital as they move into later stages of growth, and that increasingly constrains their ability to fulfill their potential. You can see this in the graph on the left. Admittedly, at the back, it'll be a bit more difficult. At virtually every funding stage, UK companies are raising materially less capital than their US equivalents. And in many cases, US companies are raising between 2 and 2.5 times more capital at each round. And that brings us to pension capital, which is what you can see on the graph on the right. Today, UK pension funds represent only around 10% of the UK venture capital funding base, compared with approximately 72% in the United States. And elsewhere in Canada, for example, pension funds invest around 15 times more into private equity and venture capital than UK pension funds. In Australia, defined contribution schemes allocate more than 20% to illiquid assets more generally, and in doing so have generated some of the strongest long-term retirement outcomes globally. Without sufficient support from our domestic capital base, UK companies scale more slowly than they otherwise could. Ambition becomes constrained, and businesses increasingly gravitate towards the source of capital overseas, often just as they are becoming economically and strategically significant. We cannot be a country that only incubates companies developing strategically important technologies but cannot scale them, or fully benefit from the value creation, employment, capability, and broader prosperity they generate. And that is increasingly where the British Business Bank comes in, both in terms of the role we play today and the role we are evolving to play in the future. Over the last decade, the bank has become the largest investor into UK venture and venture growth funds, committing more than £5 billion into the ecosystem over more than 450 funds. But what is now changing is our scale and our structure. Following last year's spending review, the bank is moving to a permanent capital base of £15 billion in our investment business. Given that we have deployed around £5 billion over the previous decade, this is a very significant step up in ambition and capability. In practical terms, it means I will be deploying capital at around £2 billion per year into this space over the next 5 years. You will feel that increase. Some of you already are. But an institution deploying capital at that scale cannot operate with the posture, pace, or processes of the much smaller program-based investor that some of you will have been familiar with from the British Business Bank over the last 10 years. Delivering at this scale has therefore required reforms that we have agreed with government across both the size and structure of our investments, alongside significant changes to our own operating model. We can, and already now do, write materially larger checks into larger funds, with ambition to help catalyze the launch of 10 new UK growth stage funds over the next 5 years. We have now adopted a more pragmatic portfolio-based approach in relation to UK investments versus non-UK investments on our funds program, which recognizes more directly the preferences and constraints faced by both LPs and GPs. And we are simplifying and accelerating decision-making across both fund commitments and direct investments, reflecting our position as a significant market participant operating in a fast-moving environment. Taken together, I can assure you this represents a meaningful evolution in posture. Recent examples just in the last few days include our £100 million commitment to a fund opposite capital in the healthcare space and in the last few days, our £40 million direct investment into Quantum Motion. Now, over time, I am committed for our relative involvement to reduce as the private market deepens. But the reality today is that there is still insufficient private capital in the UK writing checks of this size consistently. And so we are stepping up, not to replace private markets, but to help strengthen and catalyze them. As an LP, we operate through 4 investment units. Our commercial equity funds business forms the core of our equity activity, spanning venture growth and growth equity across sectors in line with our long-term strategic objectives. This activity is delivered primarily through traditional LP-GP structures, but also includes investments into regional angel syndicates, as well as listed and private permanent capital vehicles. Alongside this sits our development equity funds business, from which Mark Sims, who will be being part of a panel, leads, which plays an important catalytic role in backing new and emerging managers, where perceived risk is often higher. In doing so, it helps broaden the pool of investment talent within the ecosystem and widens access to capital for entrepreneurs, which I will come to at the end. We also partner with commercial debt funds, which remain an important part of the financing landscape, as founders need to have product choice and sometimes want non-dilutive capital for their businesses. And finally, we manage a range of legacy and next-generation nations and regions programs, supporting both debt and equity investment as targeted at specific parts of the country. I am often asked, since I joined the British Business Bank, why we do any direct investing at all. Is this the state trying to back winners, I am asked. That framing misunderstands both the role we play and the problem we are trying to solve. Our objective is not to replace private markets or compete with private investors. It is to help strengthen the domestic capital base and, yes, signal to that domestic capital base that more UK institutions can and should participate in the scaling of globally important UK businesses. The first role that co-investment plays for us is as an ecosystem multiplier. By investing alongside other funds and institutional investors, we can help increase round capacity, crowd in additional capital, and support the development of a deeper UK late-stage market by showcasing a stronger long-term track record, which is what institutional investors need to see. Second, co-investment allows us to help anchor UK leadership in strategically important companies. These are often businesses already attracting world-class international investors. The question is whether UK capital at present is meaningfully on the cap table as these businesses scale and create value. At present, around 95% of capital in UK rounds above 50 million is international. We think there is a strong strategic rationale for improving that position over time. And third, some of the most important science and technology companies, particularly in capital-intensive sectors, require investors willing to provide patient, multi-stage support over long periods of time. Co-investment allows us to act as a long-term aligned shareholder alongside specialist private investors, helping companies scale through stages where capital availability in the UK market can still be inconsistent. So, with my first-class direct investment team, co-investment for us is about using our balance sheet and position in the ecosystem catalytically to crowd in capital, strengthen market capability, and help ensure the UK participates more fully in the value creation of its own innovation economy. There is, however, as I've already alluded to, an extremely important part of the funding puzzle that the British Business Bank must now meet the moment of. The bank cannot succeed alone. Ultimately, the long-term success of the UK venture market depends on mobilizing substantially larger pools of private capital. The changes we are making in scale, pace, and posture are therefore all aligned to a broader objective, crowding in significantly greater participation from long-term UK private sector investors. While we can and must be proud of the role that the British Business Bank has played in catalysing capital over the last decade, there is now a once-in-a-generation opportunity to accelerate the mobilisation of the UK domestic savings base, particularly within the context of cross-party support on the wider Mansion House and Sterling 20 agendas. And this is perhaps where, having sat on both sides of the fence myself, becomes important. Having previously served as Chief Investment Officer of large UK pension funds, I am firmly of the view that institutional allocators need a clear choice architecture to help navigate the journey towards greater venture capital exposure. Capital will not move simply because institutions are encouraged to allocate more to it. Allocators need governance comfort, they need capability, they need access points, they need market transparency, and they need confidence in the underlying ecosystem. We are therefore helping UK institutions access UK venture capital in two ways. First, some pension funds want to help bridge their internal capability gaps as they build familiarity with the asset class and develop the confidence to invest more directly into UK private companies over time. Through British Growth Partnership Fund 1, we have created a product intended to do precisely that. This fund leverages the bank's expertise, market access, and deal pipeline to help crowd in significant additional institutional capital into UK scale-up opportunities, while also supporting a broader long-term shift in institutional engagement with UK private markets as an asset class. We recently announced the fund's first close of 200 million alongside institutional DC investors, including Aegon, M&G, and NatWest Cushion. The second and much more structural system-wide approach is through using our own activity as the biggest LP investor more intentionally to help socialize and signal venture opportunities to the wider pensions ecosystem. And this is where VentureLink comes in. I am proud to say that we have launched VentureLink's online portal on the 1st of April, giving institutional investors direct sight of the bank's LP investments and opportunities that the bank has backed that are open to LP investment. You can see a snapshot of the VentureLink homepage here. VentureLink gives allocators of capital direct visibility into the bank's venture and venture growth fund commitments in a transparent and accessible way. Each fund has its own landing page, which gives key information on the manager, their sector and stage focus, as well as details on their relationship with the bank and why the bank has backed them. The objective here is not simply information sharing. It is to help pension funds deepen their understanding of the asset class, support the development of internal investment capability, and ultimately help them build their own long-term venture allocation strategy within their private markets allocations. This online portal is just the initial step, and we are consulting further with stakeholders to explore how we can provide enhanced information that will support pension funds doing due diligence and then allocating to UK venture opportunities. Before I conclude, I wanted to highlight one other very important initiative that we believe is critical to the long-term development of the UK venture ecosystem. While scale-up capital is rightly a major priority for us, we must also continue building the market from the ground up by supporting the next generation of venture capital firms and investors. Investor Pathways is a new 400 million fund designed to back talented emerging investors from a broad range of backgrounds as they launch their first funds. Too often, highly capable investors struggle to make the transition from having investment talent to firm formation because of structural barriers around access to capital, networks, and track record development. Investor Pathways is intended to help address those barriers by supporting a broader and more diverse pipeline of new venture managers across the UK. The program is designed not only to increase the depth of investment talent in UK venture capital, but also to widen participation in the industry by creating opportunities for groups that have historically been underrepresented, including women and ethnic minorities. As part of that commitment, we are targeting at least 50% of capital of the initiative to be invested with female fund managers who meet the program's criteria. I want to close just by saying this. The UK already has the science, the universities, the founders, the creativity, and increasingly the ambition to build globally important companies. The question now is whether we can match that with sufficient scale of long-term domestic capital. Over the next 5 years, the British Business Bank intends to deploy capital at greater scale, with greater pace, and with greater strategic intent, and is already doing so, helping more UK companies start, scale, and stay in the UK, primarily through our investment in private sector funds, but also alongside our direct activity. But ultimately, this is not about increasing investment activity for its sake. It's about changing long-term investment outcomes and market outcomes. We look forward to working with many of you in helping build the next phase of the UK venture capital market. Thank you for giving me the time to speak, and happy to take a few questions. Thank you.
We are quite pushed for time in regards to questions, so I'm just going to take one, maybe two, but if we can keep them really succinct, just because we're a little bit behind time.
Hi, it's Stephen Clapham from Behind the Balance Sheet. Could you explain how your success will be measured?
So there's a qualitative and a quantitative answer. The qualitative answer that in 5 to 10 years' time, I want our relative footprint within the venture ecosystem on a relative basis to be smaller than it is today. We're proud to be the largest LP investor in venture in the country, but we think it's time for the UK domestic capital base to step up, and we are working extremely hard with pension funds, and I'm doing that personally myself to see that happen. On a quantitative basis, we are judged in terms of our financial returns on our commercial equity and debt funds, as well as our gross value add in terms of the contribution we make to the economy in terms of jobs and GDP.
Thank you, Leandros. Some interesting stats there. I particularly like the one about if you're looking to raise more than 50 million, then actually you're looking at foreign money. As somebody who works in therapeutics innovation, sorry, I'm Mark Fisher, I'm the Associate Business Director at UCL Business. Should we actually overhaul the incentives that we present to British investors to secure British money into British innovation?
What do you mean by incentives?
Things that will encourage British investors to participate in bigger rounds for that scale, rather than the UK being the greenhouse for then fueling US investment.
Yeah. So look, from my vantage point, having worked for the previous 15 years in large asset owners in the country, I have what I would consider a deep understanding of the allocation process and the journey that allocators have to make in private markets, from fund of funds to co-investment and direct. And therefore, when I step into this role, there has to be a humility and a looking in the mirror at the British Business Bank's own role in actually helping to do that. So effectively, in answer to your question, one of the things that British Business Bank hasn't historically necessarily done is actually support much larger funds to allow a consolidating pension fund system to invest in those funds that will then have the ability on a diversified basis to invest in larger rounds. And quite simply, if we don't support that, then we don't actually create the incentives to actually allow larger asset owners to do that. So, for example, Apposite Capital investing £100 million into a very large healthcare-focused fund is one example of where we are trying to encourage pension funds to do that. But all I would say, just quite simply, is that if you are a large asset owner in the UK that hasn't been involved in venture before, your first thing that you're going to do is not necessarily going to be a co-investor directly in a company, but you might be willing to back, and you should be willing to back, large funds that give you immediate access into larger venture capital opportunities in the UK.
Thank you. Unfortunately, that's all we've got time for because we are running a little bit late, but if we can give him a big round of applause for getting up. Thank you very much.